presentation, 10 minutes for comments and 10 minutes for questions from the floor. So please, Alejandro, the floor is yours.
Well, thank you. Can you hear me? Yes. Thank you for inviting me to present this paper and for including it in the conference. This is joint work with Evi Papa and Sebastian Rast. And so basically the presentation I'm going to give is closely related to what Gianluca Violante presented yesterday in the plenary. We have been experiencing in the recent quarters, I would say, high inflation over the last years in many countries around the world. And some of these changes in inflation may be more persistent than, may persist, or maybe more persistent than transitory, to put it some way. And the question that arises, and it's something that is partially in line to what we saw yesterday, is how do these persistent shifts in inflation affect the macroeconomy? And are these shifts in trend inflation, the ones that are persistent, what are the effects that they can have in the different groups of households, and in particular if they are regressive or progressive in the sense that they benefit more the guys that have higher income or lower income, the different decisions in consumption. So if it is complementary to what Gianluca was presenting us yesterday, here we are focusing on shifting inflation, not every shift in inflation, but we are focusing on shifting inflation that are more persistent. I'm going to show you now what we mean by this, but we are going to look into trend inflation, the component of inflation that is the one that is more permanent. And we are going to use historical data to try to illustrate, to try to estimate which are the effects of this type of shocks. So in the paper, we are going to identify these innovations to trend inflation in the US using a traditional trend cycle model of PCE inflation. That is the main baseline specification that we are going to use. We are going to estimate the aggregate effects that these innovations have on economic activity, inflation, and interest rates. Then we are going to focus on the heterogeneous effects, and for this we are going to use the consumer expenditure survey data from the US, and we are going to see how consumption of different type of households react to the shock. And we are going to focus on the different transmission channels. So we are going to see how income reacts, how liabilities react, how prices react. We are going to construct household-specific price indexes. And then in the end, as Gianluca was saying yesterday, these inflation shocks may be coming from different sources. And what we do in the paper is we try to classify the different drivers of trend inflation. And we are focusing here on, for example, shocks that may be driven by monetary policy. We are trying to split this from shocks that may be driven from fiscal policy and other shocks that may be coming from oil prices, for example, from oil shocks. So we are going to split the different origins, and we are going to use an IB approach to try to see if if the aggregate effects that we are showing to a genetic innovation of trend inflation are particularly different if one focuses on different type of shocks. So the channels that we are going to focus on are more, this is an empirical paper, but it's mostly inspired by theoretical works in the research. So we're going to focus on three main channels, so one can distinguish to see the transmission of the shock. The first one is the earnings heterogeneity channel. So it may be the case that when inflation increases persistently, this generates different income dynamics across different types of households. Also, if your income comes more from financial assets and if it comes more from labor income, it may also induce differential effects. We also focus on wealth heterogeneity, so wealth in particular may have different dynamics in response to trend inflation shocks, and this may this may help to explain differential response of consumption. And finally, we are going to, there's other works that have emphasized that in particular inflation may affect households in different ways, because their consumption baskets are different. So what we are going to do is we are going to construct household-specific consumption baskets, and we are going to track this inflation and try to see if when inflation globally increases, like the trend inflation is increasing, if this affects inflation of households in different ways. And we are going to see if this has an impact in consumption decisions. So to give you an outline of the presentation, the first part I'm going to focus on this identification of trend inflation innovations, and from this, there's nothing new in the paper. We are just following a traditional model from Stock and Watson to track the trend and innovation to trend inflation. Then we are going to estimate the aggregate effects, as I was telling you before, then the heterogeneous effects, and finally, in the last part of the paper, we're going to zoom in these innovations of trend inflation and split between the ones that are coming from monetary policy, the ones that are coming for fiscal policy, and the ones that are coming more for oil prices, and we're going to see if the source of the shock matters for the results that we are going to get. So how do we do to strike this trend inflation, to strike this persistent shift in inflation for the US? So we follow this univariate unobserved component stochastic volatility outlier adjusted model that has been proposed by Stock and Watson in 2016. This is one of the most popular models used to extract trend inflation in the US. And we are going to use the univariate version of they have like a multivariate, we are going to focus on the univariate version of this model. And basically what the model postulates is the traditional thing, like one can split the observed rate of inflation, I guess you can see here, as the trend component and a cyclical component, so one can split the series between the two things. And basically, the main assumption that Stock and Watson do is that the trend is a random walk, basically, which is subject to potential innovations in this trend, and these innovations in the trend may be subject to volatility that is time varying. Then we have a cyclical component, and the cyclical component is completely IID, and that's the cyclical part, and both the volatility of the two components may be varying over time. So we have like different parameters that maybe shift over time, trying to accommodate different regimes in the inflation episodes that we are going to see, that we are going to analyze in our sample. So for the data, we are going to use as observable the US PCE headline inflation, and this we are going to use the quarter-on-quarter annualized series, and our sample for extracting the trend, we try to take a long sample. We're going to take from the 60s in 2019, and we are extending this now for the pandemics as well to get more insights on what happened in the recent episodes. So the first thing that we show is once you back up this red component, so the red component is what we are going to label the trend inflation innovation. Once we back up this innovation, the third thing that one says, okay, maybe inflation is like super endogenous. We know that it's a result of different shocks, structural shocks, and they hit the economy. The third thing that one may ask is can we predict, can we try to anticipate these innovations? And basically the common practice in the time series literature in the macroeconometrics is basically just take this time series of innovations to trend inflation and regress it on past values of macro financial factors, trying to see if they can explain something of the shock. And basically what we show is that this innovation in trend inflation cannot be predictable using past macro financial factors. So in the end, we interpret this innovation to trend inflation as a combination of different structural shocks that are hitting the economy. Like it can be like permanent monetary policy, it can be changes in taxes, it can be changes in government expenditure, it can be changes in oil prices, like if you think about a very persistent oil price shock or something related with that. So this is a series that we get. So the orange line is the headline PCE inflation quarter-on-quarter annualized. So here we have from 96 to 2019. And the blue series is the trend component that we are getting here. So it's not the shock, it's a trend series by itself. And this is, one can think that, and this is the prior, maybe for most of us, like the prior would be like the trend is something more stable. So here the trend, in the way the Stock and Watson characterize the trend, is something that is shifting. Of course, we see like more shift in the 80s and in the 70s, and we see slightly more stability, especially after the 90s and so on. In the paper, we provide robustness analysis with other measures of trend that are more stable than the one comparable from Stock and Watson. And the shock series that we are getting is the first difference on this, given that this is another random walk, basically it's the first difference on the trend series that the Stock and Watson backup. And the first analysis that we do is, okay, we take these innovations to trend inflation and we say, okay, what do they contain? Like, what is behind there? So we compute like a serial correlation with respect to other structural shocks that are there in the literature. So first we compare with the permanent monetary policy shocks identified by Uribe, and we see that, so every time you see here, you will see leads and lags of the shock series relative to the contemporaneous values of our shock. And when you see a point, you will see a statistical significance in the series, so we see that the shock is positively correlating and significantly correlated with lags, leads, and contemporaneous values of the permanent monetary policy shock identified by Uribe. It's also correlated with the narrative series of monetary policy shocks identified by Romer and Romer, also monetary policy shocks identified by Gerlen and Kanadi. But it's not only picking up monetary policy, it's also picking up oil supply new shocks. So like oil supply can also have an effect on trend inflation. We also have like TFP shocks. One can think that a persistent shift in TFP is also negatively correlated, so an improvement in TFP lowers down inflation. And basically, it's also positively correlated with tax shocks from Romer and Romer. So this is more or less the evidence. So again, our interpretation is that this innovation trend inflation is capturing different structural shocks, and what we're going to see is how the origin of the shock matters for driving for the results that we're going to back. So let's focus first on this innovation trend inflation. So up to now, we have already shown that this can be explained by different shocks. So the first question that arises is, what happens when trend inflation increases in an economy? How does it affect the macroeconomic aggregates? So this is the first thing that we ask in the paper. So to answer this question, we estimate the local projection. So basically, we estimate the response of different variables, and here it will be output, inflation, consumption, investment, all different variables. From T plus H, so H horizons ahead. So today there's a shift in trend inflation in period T, and we want to see H periods ahead, what happens with the variables of interest. And we regress it on the shock series of trend inflation innovations that we have identified in the previous period, and a bunch of controls, and the bunch of controls will be lags of inflation, output, and past values of the dependent variable. Our sample period here will be from 1984 to 2019, because when we go to the CX data is available only in that subsample, like to have a comparability, it's available from before, but to have like a continuous comparability series, we will use it only from 1984 to 2019. So for the macro part, we use the same sample just to have like comparable results that we can. So when we see an increase in trend inflation, so these are the IRF. Basically, again, in the horizontal axis, you will see the different periods ahead. So in period 0, we see an increase. It happens an innovation to trend inflation. And what we see from here, so the black continuous line is the median response, and the shaded areas are the 90% confidence intervals. We see a persistent increase in headline inflation. We also see a persistent increase in core inflation, and this tends to last more than 10 years. So like that, and even if you expand more the periods, these are quarters. So basically more than 8 years we are showing here in the plot, but if you put it more longer, we also see a significant response. Inflation expectations also increase on impact. We see an increase in the 10-year rate, so these are in part reflecting the fact that the market is anticipating that this increase in inflation is going to be persistent. And they are associated with a drop in output, which doesn't happen on impact, but it happens with a lag, and also drop in consumption. So we see that this increase in inflation after some periods induces a decline in output per capita and also in consumption in per capita terms. So these are real variables, and you can interpret the magnitudes. So 1 percentage point increase in inflation that is permanent induces a drop in output of around minus 2% relative to a trend. So these are to give you more an idea of the magnitudes. What happens with asset prices that will play a key role when we analyze the heterogeneous responses? So asset prices, we see a decline in the S&P 500 measured in real terms. We also see a decline in house prices, and we see a slight increase in the net operating surplus, which is an account that can be proxy to profits that the companies are getting in the economy. But in the end, what we see, to take like an overall picture, we see that this increase in the trend inflation induces a decline in real asset prices. That's what we get from here, and this will play a role when we look into the heterogeneous effects. So now we move to heterogeneous effects. So we are getting this drop in consumption, and the first question that I want to ask is this split homogeneously across different types of households, or is this explained by a particular group of households that is declining their consumption? So we want to see if there are some heterogeneity across households. So for this, we'll again estimate the local projection, but here the local projection will be conditional, so we'll have an I as a subindex, which basically is denoting different groups of households. And we are seeing the response of consumption initially. We are going to see how consumption of different groups of households respond to the shock relative to the period before the shock happened. We are going to control for different covariates, and the covariates we are going to control the real GDP, inflation, and the lags of the dependent variable. And again, the sample period will be the same that we were getting before. So what do we see from here? So the first picture is the drop in consumption that I was showing you before. This is aggregate consumption. We see a drop in aggregate consumption in response to this persistent increase in inflation. And once we look into consumptions by different groups, so first we group them by income. We group it like low income is the third of the population that has the lowest income. Middle income is from the 33 to 66. This is the middle income, and the high income will be the top 3% of the population in terms of income. What we see is that the drop in consumption is immediate, almost immediate from the low-income households. These are the ones that are mostly affected on impact, and also if you look at the magnitudes, these are the ones that are mostly affected. Middle-income households are less affected, and the ones that are less affected are the high incomes. And maybe this is not surprising. Perhaps Gianluca was telling yesterday that, okay, we can see in some shocks that depending on the asset price, the effects on asset prices, on the effects on your income, you may see different responses. What we are getting here for this persistent shift in inflation is that basically the ones that are most affected by the shock are the households that are lower income. So what do we do in the paper? We split households across using different categories. So basically we group them by households by age. We also use the housing tenure, trying to see if being a mortgagor, a renter, or an owner makes a difference in your response. What we show in the paper, I won't have time to cover this in the presentation, but what we show in the paper is that the relative dimension to get heterogeneity is income in response to these shocks. And in the end, after showing this in the paper, what we see is, okay, what explains this heterogeneous response? What is behind this thing that low-income households are the ones that suffer the most with this persistent increase in inflation? And we explore the three different channels I was pointing you before. So we explore the earnest heterogeneity channel. So we see how income for these different types of groups react to the shock. We also see how wealth reacts to the shock, and in particular, how if they can access liabilities as well. And also we see if inflation heterogeneity, if there's some heterogeneity in inflation. So the first thing that we check, and I'm not going to show you this because we already have like many results for the short presentation. If you look at the income response across the different groups of households, we see that income declines for all of them in the same way. So income is not behind the differential response that we found for consumption. What I'm going to focus in the presentation today, I'm going to focus on the wealth heterogeneity and the liabilities, which is particularly liabilities, which is the most novel result that we find in the paper. So first, to exploit better data for this wealth, we are going to use the real-time inequality data put online by Blanchet et al. 2022, which basically uses different sources of information to construct wealth for different groups. We see that in response to a persistent change in inflation, we see a drop in wealth, general like as aggregate. But if we look at the different groups, we see that the bottom 50% is not very affected, like the wealth is not significantly affected. We see a drop in real wealth from the middle 40, so like affecting mostly in the middle group. And if you look at the top 10, and you can look at the top 1%, top 0.1%, we see that there's a slight increase in real wealth. So this may be reflecting a bit like the change in asset prices, may be helping these guys that have income, if we look in this distribution, is helping creating them a positive effect, and that's why they are not reducing their consumption, as we were showing before. So income is more or less homogeneous across groups, but the wealth effects are a bit helping them to smooth the effect of the shock. And the second channel that this is something novel that we claim in the paper, and this is one of the channels that we are pushing more is, okay, let's look at the liabilities that these households have. So we're just taking the liabilities, we look at how much they have in loans with the financial sector. And we are doing here in relative terms. So here we are comparing middle to low. So we get the ratio of liabilities of the middle group of households, middle income, relative to liabilities of the low income households, liability of high income households relative to low income households, and liability high to middle. And what we see from here is that the middle income increased relative to the low income, their share of liabilities, the high income increased relative to the low income, and the high income slightly increased relative to the middle income. So it seems that the guys that are with the lowest income households, and if you look at the level, you can look at the level responses, we see that liabilities in levels decline for all of them, except for the high income households, which are the ones that are not reacting that much. And then when you compute the ratios, that's why the ratios, like liabilities of the higher income households relative to the lower income households are increasing. So to sum up a bit, like the response that we are seeing in consumption may be partially explained by the asset prices, and maybe partially explained by the access to financial credit, to bank credit, basically, that can help the households that are with a higher income to smooth the negative effect of the shock on income. That's one of the possible explanations that we are documenting in the paper with more evidence. So I will skip this, but basically what we see here, as one would expect, is that households with lower income are the ones that suffer more inflation. And let me spend the last 3 minutes to show you that the source of the shock is important. So what we do in the last part of the paper is like, okay, up to now, that these innovations of trend inflation may be coming from different drivers, so different shocks that may be explaining this shift in trend inflation. And we ask the question, does the source of the shock matters for the shocks that we are getting before? So to ask it in another way is, does a monetary policy induce a persistent increase in trend inflation induced by monetary policy induce different effects relative to a fiscal one? So that's the question that we are trying to ask. And for this, we exploit the availability of different shock series identified by the literature, and we use a type of IV regression. So basically, we estimate the same local projection we are estimating before, but we are going to exploit the series of oil supply new shocks developed by Kansig, the permanent monetary policy shocks developed by Uribe, and the tax shocks developed by Romer and Romer, and we are going to use these shocks as an exhaustion. So we are going to keep the part of the trend inflation that is explained by these shocks. And we are going to see how much, what are the effects of the part of innovation of trend inflation that is explained by these shocks, by this phenomenon. So here, to have a picture that is a summary of everything. So in blue, we have the permanent monetary policy. In red, we have the response of the oil supply new shock. And in red, we have the response of the trend inflation increase due to tax shocks. And where we see a point, this denotes a statistical significance. So like trying to summarize information in only one figure. So all of them induce an increase in inflation on impact. So we see like a persistent monetary policy induces a persistent increase on inflation. The tax shock as the tax shock as well. The oil shock, an increase in the oil. So all of them induce a persistent increase in inflation. This is also reflected in core inflation, not only in headline but also in core. And all of them induce an increase in expected inflation and in the 10-year yield. So basically, markets are anticipating that this shock is going to induce a persistent increase in inflation on impact once they see the shock. But they differ in their effect on output. So if one looks on output, we see that a persistent increase in inflation that is explained by monetary policy induces an increase in income, while if the persistent increase in inflation is coming from oil, then we see a decline in income. So it looks like more like an aggregate demand, the monetary policy, and the supply, the oil shock looks more like a negative supply shock, basically. And the tax shock looks more similar to a monetary policy. So we see that there are different income dynamics in response to this shock, depending on which is the main driver. And the aggregate effect, when one looks at the increase in trend inflation, is mostly driven by monetary policy. So the positive effect is the one that is driving the overall response that we were seeing documenting before. And a similar pattern for consumption. And once we look into the different households, and this is to sum up, we still see that households, independent of the source of the shock, we still see that households that have lower income are the ones that are mostly affected, and households that are with a higher income are the ones that are least affected. So it seems to be that the pattern still holds. We explore the different transmission channels, the different mechanisms that I was pointing you before in the paper in detail, and I don't have time to cover this now. But we also find that the liability seems to be like a crucial channel for understanding why the different group of households are affected in different ways. So to sum up on time, again, we show that trend inflation induces a fall in economic activity, a generic trend inflation shock, an increase in inflation and nominal rates. Trend inflation have relatively better effects for high-income households in the sense that they are not so much affected in negative terms due to this increase in inflation. The wealth channel and increase in liability seems to be one of the main channels. The other one is the relative consumption basket, so the differential inflation that they experience. And the regressive effects hold unconditional on the origin of the shock. So in the three types of shocks that we have considered before, we see the same effect, the same pattern. Then in the paper we have like more detailed evidence on these channels. Thank you.
Okay. Thank you, Alejandro. So now I have Inch's comments, please. Thank you.
Hello. Thank you so much for inviting me to discuss this paper. My name is Inchi from the Bank of Canada. The usual claim applies. The views are only my own, does not reflect the views of Bank of Canada. Okay. So at the very beginning, that's a very interesting paper, which you can tell from Alejandro's presentation has a very rich empirical results. So let me quickly summarize what they do and what's new to the literature, and then I will come up with my comments. So first of all, they basically construct the trend inflation shocks based on the Stock-Watson methodology, and then focus using the aggregate PCE data, and first look at the consequence on the aggregate dynamics. So aggregate dynamics is in fact basically saying if you have a permanent increase in the persistent inflation shock, you will have higher inflation, higher long-run inflation expectations. On the other hand, on the real economy side, it will have a contractionary effect. And then they look at heterogeneous effects on household, conditioned on net income and age. So the age part is what emphasized by Gianluca yesterday, basically. So they look at different categories, including consumption, income, wealth, liability, with different channels. And most of the channels are actually pretty consistent with what we're finding in the literature. And then finally, what they do is that they use the well-identified exhaust shocks, like persistent monetary policy shocks, tax shocks by Romer, or new supply shocks as instruments for the trend inflation shock, and then redo the second part, and see whether the results are robust and to what extent the trend inflation shock reflects the changes in the persistent monetary policy shock, or tax shocks, or oil new supply shocks. Okay, so from methodology-wise, so I mean, as for sure, this is based on the methodology from Stock-Watson, and you basically tease out the persistent inflation part. And then give the shocks, they use local projection, and the local projection with instruments to study the response of all the variables of interest, particularly on the heterogeneous agents parts. So what's really new to the literature, we have a large literature on the distributional effects of unexpected inflation shocks. So what's new is first they tease out, they focus on the persistent part, inflation part, and secondly, they find a new channel for the distribution effects, which they argue that the rich households, when subject to this persistent inflation shock, because people would expect all the future inflation would go up permanently, so the rich households are able to raise their liabilities, and as a result, they can benefit from this long-run, the increasing liability because the long-run debt value goes down because of this trend inflation goes up. So this is the thing which is, I would regard this as a new channel which is not well documented in the existing literature so far. Okay, so now let's come to my comments. So my first comment is that from a general picture wise, how do we really understand this trend inflation shock from the econometric model? So put it simply, we can see that actually basically the aggregate inflation, aggregate PCE is decomposed into two parts. One is trend term, one is transitory term. So what their shock is basically this eta term. So we know that all this like inflation or trend inflation, which is both trend term and the transitory term are actually endogenous. Then the question is, what does this shock exactly mean to me? So conceptually, it could be a combination of all structural shocks. The authors mentioned, for example, this shock has a relative higher correlation with persistent monetary policy shock, or tax shocks, or oil news shocks. And recently in the literature, Bianchi and several other co-authors find like unfounded fiscal shocks. And also you can think of this could be also represent exogenous supply shocks. And with different shocks in mind that really represent this trend inflation shock, it could have different implications on the heterogeneous effects. For example, if this increase in trend inflation really come from, for example, an expansionary persistent monetary policy shock, then we could expect the housing price goes up, and then households with different housing status would respond differently. But however, if this increase in trend inflation shock really reflects this is an exogenous supply shocks, that's what we observed probably in the last 2 years during post the COVID period, then that means that the monetary policy will actually increase monetary policy to address this like increased inflation, then the housing price would go down. Okay, so that's the reason why I think it's really important to at the first stage, to understand what does exactly this shock means. So maybe I would just, the one suggestion would be, for example, if we start with a variance decomposition rather than use instruments, and tell where exactly the variation in this trend inflation shock come from. And then, to me, what's new and more interesting from the perspective of contributing to the literature is that the component in this trend inflation shock that really come from the exogenous supply shocks. Because for other type of identified shocks, the literature has already kind of studied, the channel works in the same way as those papers argues, but this component is actually what's new to the literature, that's in my mind. So the second general comment is that's another way to think about where the shock, this like trend inflation shock come from. So we know that, so the authors use basically aggregate PCE data. And we know PCE is a very large basket with many subcategories. For example, includes durable goods, non-durable goods, housing and services, etc. So then my question is, which component in the PCE basket really drives the variation in this trend inflation shock? If, for example, if the trend inflation shock really is the housing part, then this shock basically means that reflects the housing part. If it comes from durable goods or non-durable goods, that could have different implications for household consumption basket and also housing status. And it could also help to interpret the response found in the paper when you're looking at the heterogeneous inflation rates faced by the households. To me, one particular thing interesting is to what extent this trend inflation shock reflects the housing index in the PCE basket. Because housing, to me, housing is part of, you can regard as sort of assets. So the assets, typically we know that the asset price has could be more like trend component, which in that sense, the housing price could be the main source of this trend movement in inflation. And then we know, housing price changes matter significantly for the heterogeneity across households through the wealth channel. Okay. So the last part is a very relatively minor comment. It's about the explanation of the distributional effects. So, we can see from Alejandro's presentation, they have very rich results and a lot of things. So currently, they start with like heterogeneous consumption response across different income groups, and then argue that to explain these consumption differences, they follow with a series of alternative channels one by one, which I really appreciate. But however, so when I go through the paper, the question in my mind was that, is that complete list, for example, of the channels, or how should it compare with these different channels? So one thing probably I think maybe they can start with is to start with the household budget constraint, just like the papers by Auckler and other his co-authors. And then you put consumption on the left-hand side, you put all the terms on the right-hand side, and you explain one by one, which that's a one way to organize the results. And in particular, this approach, of organizing could potentially be more informative in quantify the relative contributions of the different channels, which I think that's also an important part to the existing literature. Okay, so to sum up, there's a very rich empirical result. They have very rich empirical results, and it's a very timely topic, and also providing new insights for distributional effects of the persistent inflation. I really enjoyed the paper. Thanks so much.
Thank you, Inshi. So Alejandro would like to make some.
Well, thanks for the comments. All very useful and well-taken points. Regarding the first one, we have looked a bit into that. We can do a more formal analysis and put it, maybe stress it more in the paper. I agree that it's something that is informative, like trying to see which part of trend inflation is driven by the different shocks. From the results that we have now, it seems that the most significant driver of trend inflation is monetary policy, the permanent monetary policy. That is what one would expect initially. Then the oil supply new shock is the second one, and the tax shock will be the third one in terms of the strength of the instrument. Is one way of measuring this, but again, we can provide, and we can probably have a section in the aggregate part where we talk about this, and I think it's an important point. Regarding the second one, yeah, we are following a univariate PC inflation for the composition of inflation. I agree it would be interesting to look into the different categories and trying to see if one category is the driver of the increase in trend inflation. If it's housing in particular, it may have different effects. I fully agree on that. It's like it can be something related more with asset prices. And then if you get the other chapters, it may be something more related with other components like TFP or something like that. It's something that we haven't looked into that, but it's something that can be interesting. In any case, I think that the distinction is not so trivial because in the end, house prices may be reacted to some productivity or something else going on in the economy. So it's not so, but it can be helpful. And for the last year, we have like a long paper with pretty rich, I think, lots of results in the empirical side. So we are struggling a bit to organize the results. I think putting some structure in terms of a budget constraint or something that can decompose the channels in one formula can be really helpful. So we look forward to adding that as well. Thanks, Shinji.
Thank you. So now we open to the floor for questions.
Yeah, sure.
Okay. Thanks. A very interesting paper. My question is related to interpretation of the policy or monetary policy shock. To what extent it may reflect a bit of a more tolerance for deviation from the target, for instance. So instead of being a shock, it's rather a way of reflecting that the target is not changing, but is perhaps you can accommodate the distance from the target in a more flexible way. So that's my question. To what extent it may reflect not a deviation from a given rule, but actually a tolerance for a wider range of deviation.
Thank you. João Vitor has a question too.
Thank you. Very nice paper. So when you do any univariate decomposition, essentially what you're using is just information on that specific series. And I was wondering if you did or not a multivariate one, because that may explain the results you have that's correlated with all these shocks and how the final results would be. I guess that's more or less what you're doing when you control for the other shocks in the local projection result may be similar, but I don't know. I would like to see that. And also, forgive my ignorance, but what's exactly a permanent monetary shock? I mean, I know it's a hot topic, but I would like to know what is that, an example of that, please.
Thank you. Any other person would like to ask a question? Okay, thank you. So please.
So thanks for the questions. Regarding the first one, we are just using the series of shocks that have been identified by previous works. There's a new paper which in fact appeared like last week, I think, by Ileana Kostrefi and co-authors, which basically makes that question. It's saying maybe what we are using as a monetary policy shock is just we are getting some residual in the regression that is due to the fact that the coefficients in the Taylor rule are time varying, and basically that you are getting a mixture between not to put it in an error term, but to put it like a deviation from the rule relative to some coefficients that may be time varying. And they are putting a way of trying to solve that. So maybe that's one way of getting, we may get like new series of monetary policy shocks recently, and this may help to answer Rodrigo's question, which I think is valid. The second point about the multivariate decomposition, we haven't done it. It's a bit that Shinji, but I agree that it can help us to link. So it may be the case that changes in house prices are more related to, I don't know, TFP shocks or something like this related, and it can be that monetary policy affects more like the prices of food, for example, or oil prices are more related with energy. It can be a case. We haven't looked into that. At the beginning, we wanted to focus on just an increase in trend inflation, but it may be worth like looking into that and trying to see if there's some connection with the structural shocks that we are getting in the literature. And finally, a permanent monetary policy shock. So there's this paper by Martin Uribe in the Asia Macro, where basically he identifies permanent and transitory monetary policy shocks. And you may think as a permanent monetary policy shock as a shift in the trend inflation, and shift in the way the central bank conducts the monetary policy that is going to last permanently. So one example can be the 80s, for example, the period of Volcker disinflation. This can be regarded as a permanent shift in monetary policy, more than a traditional change in the interest rate that will be reverted soon. It's like something that is more permanent. In any case, I think Peter is going to talk us about something like that in a model later on in the session. So, but that would be the way of thinking about these permanent shocks.
Okay, thank you. So now I'd like to invite Inchi to present his paper. Thank you.
Okay, great. Now I don't need to repeat my claim again. So this is joint work with Chang Liu from National University of Singapore. We try to understand inflation dynamics by highlight the role of government expenditure. So we know that, well, this is an inflation session, so I don't really need to motivate why we need to care about inflation, especially the central bank, okay? So, but we know in recent years, there's some called in the literature called inflation puzzle, basically says there's higher than predicted inflation from the series during the recession period. And also currently, in COVID period, we have inflation, environment with very high debt and also very high government expenditure. So in the literature, what they study inflation, there's typically two ways. So one way is trying to estimate in a reduced form the inflation phase curve. There's a list of recent works on this. And also another way is to quantify inflation dynamics in estimated DHE models, including the work by Jorgensen, which is cited here. Okay, great. So what do we do in this paper? We revisit the inflation phase curve by incorporating government expenditure. So government expenditure is normally considered in the context of stabilization policy. So we know that when you have the monetary policy constraint at the lower bound, there's many papers argue which the fiscal policy should kick in, stimulate the economy from a stabilization perspective. But there's very limited studies really considers its role in understanding inflation dynamics. So we highlight the supply, in this paper, we highlight the supply channel of government expenditure. We show that, first of all, I will show you a very stylized, simple nucation setup by adding the government expenditure into the phase curve and highlight the channel, how exactly the government expenditure matters from the supply channel for understanding inflation. And then we bring this seriously to the data and estimating the nucation phase curve, and we show that including government expenditure could significantly lower the slope of the phase curve. And also, including G could have a better fit with the actual inflation dynamics, particularly around the Great Recession period. So here, just to clarify, we focus on the US data case. And also, we do the similar local projection to see the general equilibrium effects, not just from supply side, and we show that was consistent with the evidence from the DSGE literature that inflation actually responds negatively to positive G shock rather than positively responds. Okay, so now let me give you a very stylized nucation model to highlight the channel what's going up here. So this equation is the standard nucation phase curve. The inflation equals to the right-hand side first term is inflation expectation plus the real marginal cost. So this is a textbook nucation model which is justified by basically some sort of sticky price or nominal rigidity. And then if we think about introduce the labor supply condition, which is marginal substitution between your labor supply and your consumption should be equal to your real wage. And this is your real labor demand. We do this in order to pin down what's the real marginal cost in the equation one. Okay. So by using the market clearing condition, which is your consumption plus government expenditure equals to the output, and the output is a function of labor supply, then we can combine the labor supply and similar demand equation to rewrite real marginal cost as a function of output and also government expenditure. And after log-linearization, we show that the real marginal cost actually could be written in this very simple form, which is positively responding to the output deviation and negatively responding to the government expenditure. So the intuition here is that when you have a positive increase in G, let's say condition on the total output, then it will crowding out private consumption. So crowding out private consumption means that the marginal benefits of consumption becomes higher as long as you have some degree of wealth effect on labor supply. Then the household would be willing to supply more labor, accept the lower wages. That's the reason why it pushes down the real marginal cost in the firm production side. So this is the intuition why we see the negative coefficients in the real marginal cost. So we bring this real marginal cost to the first equation, standard phase curve, then we can get this equation. As I highlight here, the new T here is to summarize all supply shocks, and the government expenditure enters negatively into this new Keynesian phase curve. The capital gamma here is a flexible price fiscal multiplier, typically is between 0 and 1, as shown in the Woodford 2011. So we are not saying this is a completely new thing. We are trying to take a standard as possible, simple model from literature, but really highlight this channel of like supply side channel of how government expenditure enters phase curve, and you will see later that this matters significantly to understand inflation dynamics. And this is previously this is all partial equilibrium. So what's happening in the general equilibrium? So we add back, for example, the standard IS curve from the old equation of the household, and also add the Taylor rule into here in the sense monetary policy responds to both inflation and output. And for simplicity, let's assume that the government expenditure follows an AR1 process, which is exogenous process. Then we can have a closed form solution of output response and the inflation response. So we can show that this is expression of output response, inflation response. So the rho G here is the persistence of the shock. The psi here is a constant which is larger than this parameter, which is the response of the interest rate to the Taylor rule. Remember, phi pi here is how interest responds to the output gap. And also the capital gamma is flexible price fiscal multiplier. So we can show, first of all, we can show that in this case, the eta y, which is the output response, is always positive. So this is consistent with the fiscal multiplier literature, saying that when you have a government expenditure, you stimulate aggregate demand, and then you have a positive output response. But however, if you look at this response, this actually is not necessarily positive. Actually, in most of the cases estimated in the DSG model literature, if you bring the values to plug in here, actually we can show that this actually response is negative. So it's positive only when either the persistence of the fiscal government spending is very low, or the false multiplier is very low, or this phi y is 0, which means the nominal interest rate does not responding to the output gap. So this here highlights one thing about the interaction between monetary and fiscal policy, that it's how monetary policy responds to the output gap that really matters for the effects of fiscal government spending on the inflation part. Okay. Now then we bring this seriously to the data. So what we do is that this is the canonical, phase curve estimated in the empirical literature, reduced form. And this is the one we really do. So you can see that if we are arguing that the equation 1 is misspecified as long as if the government expenditure is correlated with the employment gap, which is the economic slack, which is a typical case. And also in the recent literature, people use, for example, demand type of shocks, like I have identified monetary policy shock as instruments for the equation 1. But as we know, as long as the government expenditure is correlated with monetary policy, then this kind of demand shocks are not enough by just doing equation 1. And also, we know, I'm from the central bank, some people understand predict inflation from this like estimated phase curve. If you don't really include this term, and you will miss a big variation in the inflation from the fiscal side. Okay. So we bring this to data. Focus on US case, the sample period from like post 1990s period, in which this is a period in which the monetary policy is active. There's no debate about active or passive fiscal policy. We focus on core inflation, but we try a lot of different measures. We try two inflation expectation measures, which is commonly used in the literature in this estimating this phase curve. And also we use to measure economic slack, we commonly use the employment rate less the Congress Budget Office estimated natural rate of employment. So I just want to highlight one thing, is that we check the way of how typically in the data people construct natural rate. So the natural rate construction typically considers production capacity, which is come from productivity, but not really takes into account like short-term physical variation into account. So you can imagine that if the natural rate in the data already includes the physical variation, then the right-hand side, the G here will directly enter this output gap or employment gap will not show up as an actual term. And the economic expenditure we just take from the USBEA data. Okay, so in order to address the potential endogeneity issue, we also use the IV approach. So we take both IVs from high frequency identified monetary policy shocks and physical shocks or defense shocks to also, in this macro literature, there's also another popular issue which is called many instruments issue, because you will include a lot of lags of the monetary policy shock as instruments. So in order to address this, we also follow the Burnish-Masters Q.A. 2020 paper by a dimension reduction of the number of the instruments from like a 16 to like 6 in order to address this part. Okay, so we tried with different shocks. Like the baseline was military spending shock. We also tried alternative shocks construct from RAMI, from SPF, survey of professional forecast, or from RAMI Rubseri's, for example, narratives approach of the news shock about fiscal policy. For monetary policy shocks, which is very commonly used, the high frequency identified monetary policy shocks. Okay, so this is what we get. So column 1 and column 2 is by estimating the phase curve I showed you before by using SPF survey data. And the right side here, column 3 and column 4 is using the Michigan survey data. So first of all, we see column 1 and column 3 are the case that we do not add the government expenditure into the regression. And you see that actually the slope is relatively big, and also you can see a positive inflation expectations and also a negative coefficients before employment gap. But once we add government expenditure into the regression, we see that first of all, you still have positive inflation expectations, but in general it becomes weaker. And on the other hand, the slope before the employment gap becomes much smaller, significantly smaller, more flatter. And also, we have a significant negative coefficients in government expenditure, which is consistent with the theory, as I showed you before. And here, well, if you do this empirical work, a big challenge would be whether these are weak instruments or not. So here we do a formal test about whether it's past the weak instruments issue. So the first column here is a case by the first row here is by using only monetary policy shock as the instruments. So we can show that actually, in either case, in all the cases, either it's without G or with G or Stock-Yogo statistics or like the other like Lewis-Merton statistics. In all these cases, if you just use monetary policy shock as instruments, that's what the literature has already done, the monetary policy shock is actually a significant weak instruments. But however, if you include both monetary policy shock and identified physical shocks, you see that actually in all of this tests, it passes 95% confidence interval, which is in our exercise case. Okay, so that's one lesson to learn, is that when you use monetary policy shock as instruments in your exercise, then potentially that could be subject to a significant weak instruments issue. And we are doing a bunch of robustness checks, like different, IV estimators, different inflation expectations estimators. We also tried output gap instead of employment gap, or like hybrid versions of the retention phase curve by adding lags or lagged permanent government expenditure. So given the estimated phase curve, how can help us understand inflation dynamics? So this figure shows you that we take the estimated phase curve, and we construct how much the variation. So how much of the variation in inflation come from the term of economic slack, which is measured by employment gap, and how much of the variation in inflation come from government expenditure. So starting from 1990s. So you can see that actually the contribution from government expenditure has almost the same quantitative scale as the contribution from employment gap. That's the reason why we argue that if you ignore government expenditure into phase curve or thinking about this issue, you will miss a big piece of variation in inflation. You will regard this like variation to like something like exogenous supply shocks. And also in most of the historical periods, this two moves in the same direction. But there are some periods which is right around the Great Recession. After the Great Recession, they move in the opposite direction. So this also could help us to explain which is literature called misinflation puzzle, which we will talk about on the next slide. Okay, so let me skip this. So if we look at the model predicted inflation versus real data, by specific focusing on Great Recession period. So this figure shows you here, the circle dots is the real data, core CPI, okay. So we see, this is also the, moving average over the past 4 quarters. So you see that there's around, a bit later than 2010, you see a big drop in the data, and afterwards the data actually quickly reverts to like slightly above 2%. So the red line is the case without estimating, including G into the phase curve estimation, which is the literature did. So you see that with the red line, it's close to the drop. But when the data recovers to about like 2%, the predicted inflation is much lower, which is about like 1.5%. So this is what we regard as the missing inflation puzzle as argued in the literature. And this gray line is a case that we including G into estimation, but does not including G into the model predicted inflation. So we see that first of all, because now in this line, the slope of this curve becomes much flatter, so we don't see much drop during the recession, and also not much increase after the recession. But the last line is the case in which we not only including G into the estimation, but also including G into predicting the model predicting inflation. So you see that on this case, on the one hand, it has a, pretty good fit with the dip in the inflation during the recession, and afterwards it's much more higher than the case compared with the case if you do not include the G into the prediction, and also which is much more close to the data. So that's the reason why we say with this, by considering government expenditure, it provides us an alternative perspective to the missing disinflation puzzle in the literature. Okay, so now let's see the general, previous slides, how to understand inflation dynamics derived from phase curve. Now I show you the response from general equilibrium perspective. So in order to see the general equilibrium, we do the local production method, which is pretty common nowadays. So the left-hand side figure shows you the impulse response of inflation to a positive innovation in government expenditure. And the right-hand side shows you the inflation expectation response. It's maybe surprising to the general audience, but maybe not so much surprising to the people in this literature is that the inflation response in general equilibrium actually is negative, not positive. Because the common wisdom is that you have a government expenditure, you stimulate aggregate demand, you raise output, and potentially you also raise inflation. But actually here, this is what we actually find is that the inflation response is negative. This is also consistent with some, Jorgensen's paper using DSG models. And not only inflation, but also inflation expectations has a negative effect. So then we further want to see where does this effects come from. Then we further decompose the sample into the ZLB period and non-ZLB period. So this figure then shows you, the left-hand side shows you the response of inflation during the ZLB period, and this one shows you the case of response of inflation in the non-ZLB period. So we can see that in the ZLB period, the response is pretty close to 0. And okay, so this 2 lines is 95 confidence interval, this line is the point estimates. So this is very close to 0, but in the non-zero B period, it's significant negative. So in that sense, on the one hand, the negative response inflation, what we observe in the data, mostly is that come from the non-zero B period. On the other hand, this is also consistent with the theory on government expenditure in the sense that we know during the ZLB period, government expenditure could have higher effects on the demand side, which stimulates output more and also have a more powerful effect, positive effect on the inflation. That's also a reason why in the ZLB period, subject to this government expenditure shock, the response in inflation is higher than the scenario in the non-ZLB period. Okay. So in the paper, we also make up an extended model to reconcile the impulse response, for example, of wages to the government expenditure. But here, due to time limit, I don't go to detail there. So let me sum up. The government expenditure is important. We argue that government expenditure is important in understanding inflation dynamics. With the augmented phase curve shows a flatter slope with the phase curve. And also adding G to the phase curve solves the missing disinflation puzzle. And also we argue that the G here could account for significant variation in inflation. The whole point we want to highlight is the supply channel of G in the phase curve. Okay, great. Thanks so much.
Thank you, Ish. Now I'd like to invite Peter in order to make some comments.
Hello. All right. Thank you so much for inviting me to discuss this very interesting paper and for putting my paper on the program as well. What this paper does is that it speaks to two strands of literature. First, relatively small empirical literature on the inflationary effects of government spending shocks, which uses a wide range of structural VAR models to show that an expansionary government spending shocks actually generate disinflation or deflation. And then a very large literature, of course, on the flattening of the Phillips curve. And of course, related to that, the missing disinflation puzzle, that inflation didn't decline very much as much as we would expect during the Great Recession. And it basically combines kind of these two results, essentially asking, can result number one explain the result number two? So particularly, if a reduction in government spending, so fiscal austerity, if that actually increases inflation, then fiscal austerity during the Great Recession would make the Phillips curve look flatter because a recession would be associated with a smaller drop in inflation. And I think that's a great idea to couple those two strands. So what the paper does, it mainly has three exercises. First, deriving an augmented New Keynesian Phillips curve with G, government spending, from a standard model where government spending then enters the Phillips curve with a negative sign due to a wealth effect on labor supply. And then estimating a New Keynesian Phillips curve with exogenous instruments, showing that kind of consistent with the theory that G enters with a negative sign, and that the structural slope is substantially lower when you include G in the estimation. And then, of course, that lower G can help explain the missing disinflation puzzle. And then finally, they do a local projection exercise to estimate the effects of government spending shocks on inflation, showing that indeed they are deflationary. So my comments and questions. First, my first comment is on the missing disinflation puzzle. So I just want to go like a little bit back in time and talk a little bit about like how big was this puzzle in quantitative terms. So of course, when we think about inflation dynamics during a major financial crisis, the historical backdrop would be the Great Depression. And during the Great Depression, we saw like 10% deflation in the US in 1932. And I think that's probably, like a lot of people actually expected that something similar would happen during the Great Recession, that we'd actually see deflation. And that would also be consistent with a standard reduced form Phillips curve estimation. So this is from Koibjørn and Gordichenko 2015, their paper on the missing disinflation puzzle. And a standard model here would be a backward-looking Phillips curve or an accelerationist Phillips curve. And that model, conditional on the actual path of economic activity, I think they used the unemployment rate here, would imply, very strong deflation. So this is minus 4% inflation in response to that crisis. So the missing disinflation puzzle was huge. So the gap between, the model predicted inflation rate and the actual inflation rate was around 6 percentage points. So that's a huge puzzle. So my first comment would be that kind of the model predicted paths of inflation, I don't think that kind of any of those models really imply, I don't want to get into semantics, right? But I don't think they really imply a missing disinflation puzzle, because in all of these simulations, inflation actually declines less than it does in the data. And I think, so I agree that it can explain some of the variation here in 2012, 2013. But I think the thing is that these simulations use actual survey data as input in the simulations. And I think kind of the consensus is that once you do that, once you control for actual inflation expectations, that is the resolution to the missing disinflation puzzle. So that's and related to this, I think it's also a bit unclear like which of these models is actually kind of performing better. So I see that the proposed model is, it's performing better here, but slightly worse down here. So I think it would be nice to see like just a formal measure of the fit. Okay, so my second comment, something that I think would be, even if it doesn't resolve the missing disinflation puzzle, it could still help explain the flattening of the Phillips curve, and I think it would be super interesting to look more into this. So the authors show that when you estimate the model on the full sample from I think 89 onwards, that the slope is smaller when you include G in the estimation. But I would like to see some subsample stability to see, does it actually, accounting for this mechanism with G, does that actually imply a more stable structural slope coefficient over time? Does it actually help explain the flattening of the Phillips curve? So that would be super interesting. My initial thoughts is that, if I understand the mechanism correctly, then, if G becomes more procyclical over time, then that would mean that the reduced form Phillips curve would flatten. On the other hand, as the authors show, the sign of the inflation response depends on many different structural parameters, including some monetary policy coefficients, which may also have changed over time. So it's kind of unclear exactly how that would affect the slope of the Phillips curve, but I think that would be a really, really interesting future avenue. Then my next comment is about the consumption response in the model, because the authors show that the model implies a negative real wage response, which is inconsistent with most structural VAR evidence, and they show that they use this learning by doing mechanism to overturn that prediction, so you get a real wage increase instead. And I was just wondering about the negative consumption response in the paper is also kind of inconsistent with a lot of empirical evidence. So I was just wondering if that LBD mechanism if that also can overturn this decline in consumption, or alternatively, maybe the negative consumption response is in fact not counterfactual. Maybe local projections would actually say that that consumption would decline in response to the shock, which in that case would be interesting to see. My last comment is more of a technical comment. I was wondering about that when you derive the New Keynesian-Phillips curve, so the theory implied New Keynesian-Phillips curve, as I understood it, this term right here is the unemployment gap, so that's the unemployment rate and deviations from, that is the unemployment rate and deviations from steady state. And if I understood correctly, government spending would not show up in the expression if it was instead in deviations from the natural rate. But then in the estimated Phillips curve, if I understood correctly, this gap right here is instead the log deviation of unemployment from the natural rate. So I was just wondering how you kind of would justify that assumption, and if it matters. I'm not sure if it matters. Great, that's it, thanks.
Okay, thank you. Would you like to react?
Sure, yeah, great. Thanks so much for the comments, Jorgensen. Yeah, that's all very helpful. So maybe I can take reverse order to respond to the comments. So first off, it's about this whether we put the employment gap into the data or just the employment into the data. So we know that from the theoretical model, the natural rate typically is a flexible price equilibrium. In the natural rate, in the model will actually include G into the theory. But in the data, we carefully check that in most of the countries, when the statistics bureaus construct natural rate, they don't really consider short-term physical variations. So that's the reason why intentionally in the theory part we not put the natural rate there, which put log deviation from the steady state, and then from the empirical part we use more commonly used in the literature, which is using the output gap or economic slack by incorporating the natural rate there. So that's actually an intentional choice. The second part is about consumption response. So that's completely correct. So in the current setup, because we are trying to make it as simple as possible, we try to say, okay, the simplest framework, you can see a significant effects or significant, this is a significant channel. So in that case, then we do imply a negative consumption response. So we should, as Jorgensen said, we should definitely check like the local production response of consumption to government expenditure, and see if we can also reconcile in this like consumption response in the extended model. And the first one is about missing disinflation puzzle. So I think it really depends. This is really a matter of how we're framing the results. We totally agree with that. Once you put inflation expectation data into estimating the phase curve, you will not see as much gap as argued in the papers in the Kohobi and Konichenko's paper using like lagged inflation as inflation expectations. So inflation expectations do matters a lot for solving the missing inflation puzzle. So what we are arguing, probably we should reframe this is in the sense that on top of you put inflation expectations, you still see a relatively big gap in the sense like, for example, like 1% or like nearly 1% inflation gap from the data and the model, the inflation implied by the phase curve. And this gap can actually largely explained by this like inflation, this like fiscal channel. Otherwise, you have to regard this as exogenous supply shocks, which is not really well micro-funded. Yeah. So that's pretty much up my response. Thank you.
Thank you. So now we open to the floor for questions. Over there.
Do you hear me? Okay, hi. Yeah, so you're saying that the channel is the government spends more, people feel poorer, they work more, the wage goes down, inflation goes down. Is that correct?
So the argument is channel is like the government expenditure increase, crowding out private consumption. And then you are willing, as long as you have some degree of wealthy effective labor supply, you want to work more.
Yeah, because you feel poorer, right?
You feel poor,
But
yeah.
is this, do you really think that this channel is, because like government expenditure is about bringing more money into the economy, usually by issuing debt. And a lot of this is in the form of transfers, directly transferring the money to the people because you're using a total expenditure. So do you really think that this generates a negative income effect?
Okay, so that's a great point. So I need to clarify here. The expenditure we use is just like government spending or government expenditure in the sense that it does not include the fiscal transfer directly. I totally agree with you. If you give the money like fiscal transfer, that works in the opposite direction. But this is a case in which, for example, typically studies in the US, like for example, Woodford 2011 and other papers, that is a consumption. You can think of this government expenditure as a consumption of the government. It's not like the transfer of money to the household. Yeah. So that makes a big difference. Yeah. But I totally agree with you. If this is like fiscal transfers, then the wealthy
you're using total expenditure, right?
No, not really. We use the total expenditure minus the I don't remember the exact name, but that's the consumption part of the government. Yeah.
Still, government spending is about hiring new workers, buying new stuff. So it's raising demand. So it's unlikely. I mean, it's hard to believe that this would lead people to feel poorer.
Yeah, please.
People are not Ricardian, that's my point.
Yeah, that's great. So the channel you're saying is exactly the demand channel, which is you have higher government expenditure, which stimulates aggregate demand. That's exactly the demand channel. But here, that's the supply channel we're emphasizing in the sense that that's the reason why we're saying typically common wisdom is like you have government expenditure, the demand channel dominates such that both inflation and output will increase. But we show theoretically, even in the simplest model, that the output will necessarily goes up, but the price will not necessarily goes up. Depends on whether the supply channel dominates or the demand channel dominates. Yeah.
Okay, thank you. Rodrigo, please.
Yeah, yes, very interesting paper. It seems that you show that the response of inflation to G depends on the phi Y coefficient, so the response of the Taylor rule to the output gap. If you assume that this is not constant, perhaps even during this, or perhaps because of the recessions, how do this will affect your results if phi Y is increasing, for instance, if the Taylor rule puts more weight to the output gap?
Yeah, so I mean, in the paper, we assume the policy reaction function, the coefficients is constant, but generally the results will hold if even it's time varying. But the key point is that it's the interest rate response to output gap rather than inflation that really matters for the inflation response to fiscal spending or fiscal expansion. That's the point that we want to make. So as you said, if the coefficients of how interest rate responding to output gap becomes smaller, then the response of inflation to a government expenditure would be actually higher than otherwise, yeah.
Okay, so now I think you can go on to the next presentation. So I'd like to invite Peter. Thank you. Make his presentation.
Okay, thanks again. So this paper is titled Anchored Inflation Expectations at the Output Cost of Disinflation. And the motivation behind the project, of course, is a quote-unquote missing recession of 22-23. Historically, as you all know, disinflations have been very costly, both in the US and elsewhere. Cacchetti and co-authors have a recent paper kind of going through all of the major disinflations across countries over time, showing that, okay, they usually are associated with pretty big recessions. So given this historical record, many prominent economists argue that disinflation in the 2020s would also require a recession, and prominently Larry Summers said we need 5 years of unemployment above 5% to contain inflation. And as you all know, that didn't, at least so far, has not happened. So at least so far, post-pandemic disinflation has essentially been costless. So I'm showing you core inflation and the CBO output gap during respectively the Volcker disinflation and then post-pandemic disinflation. And so from the inflation peak and onwards. So during the Volcker disinflation, starting in 81 Q3, inflation came down from around, I think, 13% core inflation down to around 4%, but at the cost of a huge recession. So the output gap went down to minus 8%. So that's deeper than the Great Recession. On the other hand, post-pandemic disinflation starting in 22, during that time, inflation came down from around 7% to around 2%. And the output gap just remained nearly constant in positive territory. So no decline whatsoever. And the same goes for the unemployment rate, which remained almost completely stable at 3.5%, which is super low. So post-pandemic disinflation in a historical perspective is, at least so far, again, disclaimer, has been pretty costless. So from a theoretical point of view, that development may not be as surprising as suggested by the historical record, because a standard New Keynesian-Phillips curve would say, well, if longer-term inflation expectations remain perfectly anchored in response to a temporary inflationary shock, say a supply shock, well then the Fed does not have to subsequently engineer recession to bring down inflation, because once the shock is gone and expectations, if they have remained perfectly anchored, inflation will just go back to 2%. And you don't have to engineer recession to reduce inflation. So in that case, disinflation would be costless. So just a brief empirical observation. Here I'm showing you core inflation and then two measures of long-term expectations from surveys, so the Blue Chip survey and SPF. We don't have that much data from the late 70s, but what we do have shows us that in the early 80s, inflation and long-term inflation expectations increased in tandem. So during this one-year period from 79 to 80, actual inflation rose by 1.5%, and 10-year expectations rose almost equivalently by 1.4%. And in the 2020s, that did not happen, right? So from 21 to 22, actual inflation went up by 5 percentage points, and long-term expectations in the data rose by like 25 basis points. So basically constant. Okay, so I posed two questions in this paper. So first, what explains the improved anchoring of long-term expectations in US data? And secondly, can improved anchoring explain this missing recession of 22-23? And what I do is that I estimate basically a vanilla New Keynesian model, but extended with imperfect information. And the imperfect information assumption is that agents are fully rational in the sense that they know the true model, but they can observe the shocks. So they solve a signal extraction problem to disentangle temporary demand and supply shocks from highly persistent shocks to the inflation target. And then I show in that model that the degree of anchoring will be determined by the relative variance of temporary demand and supply shocks versus shocks to the inflation target. And then I do a Bayesian estimation of that model on 2 subsamples, first from 1960 to 98, and then from 99 to 23. And I split the sample in the late 90s because several recent papers have shown that this anchoring process was finalized in the late 1990s. So what I find is that improved anchoring is explained by the adoption of a fixed implicit inflation target. Because if the inflation target is stable, then people won't revise their long-term inflation expectations in response to high inflation. And in that case, inflation will simply just be driven by temporary shocks. So inflation will essentially be temporary. And then I show that improved anchoring can explain the missing recession because it reduces the sacrifice ratio. So how much output you have to give up to reduce inflation. In the interest of time, I'm going to skip the literature. It's huge. So the model is super simple. It simply just consists of a new Keynesian-Phillips curve with a supply shock, a policy function, which is the optimal policy rule under discretion, subject to 2 shocks, a time-varying inflation target, stationary but highly persistent, and a demand shock. Well, a policy shock, I'm just going to refer to it as a demand shock. And all of the shocks follow AR1 processes. So in the full information case, people's short-term inflation expectations will simply be a function of the observed inflation target, the observed demand shock, and the observed supply shock. In the imperfect information model, I'm going to assume that people can't observe those shocks, so they have to estimate the inflation target and the demand shock and the supply shock, and then base their forecast in a rational way on those estimates. So they know the true model, but they can only observe inflation and of course their own inflation forecast, and then they have to solve a signal abstraction problem to infer these 3 state variables. Okay, so you can easily show that by combining the Phillips curve and the policy function that you get this equation right here where on the left-hand side we have the signal, and on the right-hand side we have the unobservables that the agent is interested in estimating. So we can use that signal to decompose, we can decompose that signal into 3 components using a standard Kalman filter, where the steady state, these 3 steady state Kalman gains, we can solve for those numerically. Okay, anchored expectations definition, it simply follows the original definition by Bernanke that anchored means relatively insensitive to incoming data. So under some simplifying assumptions, I can use this model to derive this expression, showing that expected inflation at any future horizon h is equal to my estimated inflation target, and I update that inflation target in light of recent forecast errors. And then I define this parameter lambda, this gain parameter, which will then be a function of all the structural parameters in the model, including, first and foremost, the inflation Kalman gain. And the inflation Kalman gain will be given by this formula right here, the optimal gain, where phi is the signal-to-noise ratio, and then in this simplified version of the model, the signal-to-noise ratio is simply just the variance of the inflation target shock relative to an expression which is a function of the variance of the temporary demand and supply shocks. And this is just to provide some intuition. Note that if the variance of the inflation target shock goes to 0, meaning if the central bank's inflation target is completely constant, well then, by definition, the signal-to-noise ratio will be 0, the inflation Kalman gain will be 0, and the updating gain, the anchoring measure, will be 0. So in a world where the Fed has a completely constant inflation target, people's inflation expectations will also be completely anchored. Okay, so in the estimation, I use core inflation, the CPI output gap, and then I use both short-term and long-term inflation expectations from the data. I use professional forecasts in the baseline, and then I use consumer forecast as a robustness check. I'm going to skip this. I use a pretty standard prior distribution. I'm just going to show you the results from the baseline case with professional forecasts. So most of these estimated parameters are quite constant over time, with one important exception, the volatility of the central bank's inflation target. So which in this case declines from 0.06 to 0.01, which in turn means that expectations become more anchored. The gain parameter goes from 0.23 to 0.05. So in other words, a more stable inflation target means a lower, value of this parameter right here, which in turn leads to more anchored inflation expectations. Okay, so the question is, what does that mean for the output cost of disinflation? So I just do like a simple case study, just look at the bulk of disinflation versus post-pandemic disinflation using this estimated model. So a key feature of this imperfect information model is that it disentangles the perceived inflation target from the actual inflation target of the central bank. And you can use the model to estimate time series patterns for both of these variables, and that's what I have here. So the dashed bold line is the estimated actual inflation target, and the solid black line is the perceived inflation target. And so a key feature of the early 80s and the 2020s is that in the early 80s you have a huge gap between the perceived inflation target and the actual inflation target of the central bank. So long-term inflation expectations were much higher than the inflation target. And in 2022, that was not the case, right? There was virtually no gap between those two, a 10 basis point gap. And this was also, like this key difference was also acknowledged by the governors at the time. So Paul Volcker said in '79, he said, part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. So, okay, my job is, to a large extent, to reduce inflation expectations. And Jay Powell in '22 said, well, today by many measures, longer-term inflation expectations appear to remain well anchored, so his job was not to reduce inflation expectations. Okay, I'm doing like a bunch of exercises in this paper. I'm just going to show you two of them. So the first one is just in-sample forecasts of the Volcker disinflation and the post-pandemic disinflation, where I basically just use the estimated parameters from the two subsamples, and then I just turn off all of the shocks after the respective inflation peaks in '81 and in '22, and just see, okay, where does the model take me from there? Does the model predict a recession or not? And these are the results. So red dashed line is the Volcker disinflation, and blue dotted line is the post-pandemic disinflation. So initially, during the Volcker disinflation, we have this huge gap between the perceived target and the actual target, which means that disinflation takes a long time and requires a pretty big and long-lasting recession. And that's simply because even with poorly anchored long-term inflation expectations, they're much more persistent than supply shocks and demand shocks. So therefore, it's just much more costly to bring down expectations-driven inflation than to bring down demand or supply-driven inflation. And we see for the post-pandemic, inflation basically just comes down freely, so to speak. So it doesn't require a major recession. The sacrifice ratios, reduced form sacrifice ratios over a 10-year period is for the Volcker disinflation 1.6, post-pandemic 0. Okay, another exercise is a counterfactual simulation where I'm just asking the question, okay, if expectations had been as poorly anchored in the 2020s as they were in the 70s, 80s, what would post-pandemic inflation have looked like? So I just do two simulations. First is the baseline. So in the baseline, I'm setting the volatility of the central bank's inflation target shock to its post-1999 value, which is 0.01, which implies a gain of 0.02. So well-anchored inflation expectations. And then in the other case, I'm assuming all the same parameters and the same shocks, etc., except that the volatility of the inflation target is 6 times larger. It's the pre-1999 estimated value. So a more volatile inflation target means more poorly anchored inflation expectations. And then I just do a simulation using the parameters estimated on the post-99 subsample. And these are the results. So here we see core inflation, 10-year inflation expectations, and the output gap implied by the model. So So in the baseline case, expectations don't increase very much, and inflation doesn't increase that much, and the output gap remains in positive territory. And we have a sacrifice ratio of actually slightly negative, minus 0.3. And in the counterfactual scenario where expectations are unanchored, but I'm using exactly the same shocks, we see that long-term inflation expectations increase by 3 percentage points, up to 5%. And that in turn means that, of course, inflation is a bit higher. And the Fed has to push the output gap persistently into negative territory to contain inflation. And that simulation gives me a sacrifice ratio of 1.2, so almost as high as during the Volcker disinflation. So simply highlighting that the reason why we're not seeing a recession is, at least according to this model, first and foremost, because of well-anchored inflation expectations. Okay, so I see I'm actually going to finish a little bit ahead of time. So just to conclude, improved anchoring is explained in this model by a more stable inflation target. And improved anchoring, it lowers the sensitivity of long-term inflation expectations to temporary demand and supply shocks, and it implies a substantially lower sacrifice ratio, again, because if long-term expectations remain perfectly anchored in response to a temporary shock, then the Fed doesn't have to engineer a recession to bring down inflation once the shock is gone. So that can help explain the missing recession of 22-23. Great, thank you very much.
Thank you, Peter. So now we have Alejandro's comments.
Well, thank you for inviting me to discuss this paper. So I will first give a brief summary. It's a very interesting and timely paper, I think, talking a very, very, very much important topic nowadays. So it analyzes how long-term, long-run inflation expectations, so not long-term, how long-run inflation expectations affect the cost of disinflation. The author proposes a model where there's imperfect information. Basically, you can take that agents don't know exactly the source of, they are not sure about the target. Basically, there can be shocks to the perceived inflation target. I would call it like that. There can be demand shocks and there can be markup shocks. The two first shocks, demand and markup shocks, are the standard shocks that you can see in a New Keynesian textbook model, and the last one is probably the novel part of the paper, what he adds. And then the problem in this imperfect information setup is which type of shock is driving the different things, and how does this effect creates different decisions, induce different decisions. So the authors compare the predictions from this imperfect information model with one that has a perfect information model. And the model is used basically to evaluate, Peter didn't have time to cover this in the paper, but the paper has also an additional exercise, which I think is pretty interesting, and I will get a bit into this in the discussion, is which are the effects of rising inflation target, if this can be helpful or not, and I think this is a discussion that is going on in many countries nowadays. So to give you an idea of the model is a standard New Keynesian model, so one can think. Again, we take the Phillips curve, we have the yes, we have and then we have the process for the shocks. Here we have just the markup shock, we have the demand shock, and we also have an inflation target, and the novelty is that this inflation target that usually we take as fixed in a standard New Keynesian model is subject to an air process and a shock. This epsilon is the one that is moving this inflation target. And then the other parameter that is important is this mu. This mu basically reflects the importance that the central bank puts to stabilizing inflation relative to stabilizing output. So we can think of this as being derived from combining the IS curve basically with the monetary policy rule, the Taylor rule. And the important thing is that this inflation target is not zero, and it can be time varying. So basically it can be something that moves from there. This autoregressive coefficient rho pi, it's something that is very close to 1. It's very close to the unit root, but it's not the unit root. So basically, you can think as a deviation from it, and this can be a permanent monetary policy shock. It can be a deviation from inflation relative to the target, but then in the end, at some point, the model converges back to the previous steady state. So this is the trick that the model is doing. What are the findings that the paper has in this framework? Well, again, the adoption of a fixed inflation target has contributed to anchor long-term inflation expectations. This is one of the key things that Peter is pushing in the paper, that I think he provides evidence, again, doing many counterfactuals that I think are very informative. Anchoring inflation expectations reduces the effects of transitory shocks on long-term inflation expectations and the cost of this inflation. This may also sound like something natural. So if I'm in a world where all the Asians believe that the central bank has a target of 2%, there can be shocks in the economy, but stabilizing the negative effects of the shocks is much easier relative to a world where Asians adjust their inflation expectations. I think that's the summary. But the most important thing of the paper is quantifying this. Okay, this is maybe in line with priors, but we don't have, I think, like such a quantitative exercise as the one that Peter is doing. And in particular, what he finds is that the sacrifice ratio in the workerless inflation period was 1.6. So here again is how much you have to sacrifice of output relative to the decrease in inflation. And the sacrifice ratio in the post-pandemic period is 0. So basically that's the two things, that the two exercises that Peter compares in the paper. And then the last one is like he has an exercise that he didn't have time to show today, that if you increase by 1 percentage point the inflation target over a 3-year period, this would raise inflation volatility in the persistent by 40%. So again, this is questioning a bit the idea that raising the target may be a good thing. Like again, because of this effect that it may de-anchor inflation expectations and may induce more volatility. So I think it's a very interesting paper which tackles a crucial question nowadays for many economists. I enjoy reading it. I think it has like many counterfactuals that is helping you and driving you through the different results. And in particular, I guess that the quantitative part is probably the most relevant. My discussion is about like how do we link these inflation expectations with recent works that have been done in this literature that I think are crucial for the message of the paper. Some technical things about estimation, which I have some comments there. And finally, the role that I will see later on this exercise of raising the target. So the paper, as Peter explained before, so he gets this new Keynesian model. He just gets observables to estimate the models. He does a Bayesian full estimation of the model. And as we can see, he uses in this estimation inflation forecasts from professional surveys, and from consumers inflation also surveys as forecasts, as a robustness for this exercise. And there's a huge literature analyzing inflation expectations nowadays out there. I don't want to go through all the papers in detail, but there's, for example, a paper by Ricardo Rice in 2020 where he shows that survey-based measures of inflation expectations differ from those that one can back up using financial markets. And then the point of this paper is to show that this may be related to some cyclical parts of the economy. So in particular, one question that arises is, are the results robust to using alternative measures of inflation expectations observable in the model? Like this is something that I think it's interesting to see. And the second question is, what does anchoring inflation expectations mean nowadays? Like there's a lot of debate around this concept. And in particular, there's a very recent paper that is related to this paper in the sense that it also looks into long-run inflation expectations, which is a different animal related to the short-run inflation expectations. So there's a recent paper by Fisher, Melosi, and Ras, where basically the paper is basically called long-run inflation expectations. They just take the survey of professional forecasters, which is exactly the same data set that Peter is taking, but they just look at the cross-section. So Peter is looking more at the median, the mean, or some summary statistics from this survey. What the authors do is they look at the cross-section, so they look at what different guys respond over time about the long-term inflation expectations. And what they document in this paper is that there are misperceived precision and persistence of the knowledge. So basically, there's a persistent bias and overconfidence in private information. So there are systematic errors in what each agent makes over time. And these errors are persistent. So in the end, this questions a bit the idea of, okay, we are taking like guys that basically are making persistent errors. We are taking a median of this, and we are taking this as a proxy for inflation expectation. Maybe this is not the right measure to take, like to define an anchor in inflation expectations. Maybe one needs to look at other moments, I don't know, second moment, third moment, like trying to look more into this information. And a second related question to this one is, in the model, one can back up what the short-run inflation expectations is, so which is the expectation about PT plus 1, and one can compare this to what is inferred from these consumer surveys, and one can see if the model more or less generates a similar short-run inflation expectations relative to what the data is telling us. So this can help us a bit to discipline, to see if the fit of the model in this type of observable is good enough or not, given that, again, expectations play a key role in the story of the paper. So in the second part, my second comment is related mostly to estimation. So the authors, as he explained, splits this long sample in the before and after 1999 and estimates the model in two subsamples. In the two subsamples, you have the problem that before 1999, the average inflation was significantly higher than 2%. In the post-1999, if inflation is around 2%. So what he does for this is he just demeans the series of inflation by 2%, and then you will have like a big deviations of inflation around 2% in the initial sample, and then you will have something around 0 probably in the period after 1999. So I was wondering if this affects significantly the variance of the epsilon, which in the end plays a key role in the analysis that he's making. There's not the right choice to do here, I guess, at least for the estimation, but one additional exercise that one can do is one can demean inflation in the previous period, taking the median or the mean inflation in that period, which probably is higher than 2%, and trying to see if this affects significantly the estimates of the sigma epsilon, which in the end is a key parameter in the model. Again, this would imply different like steady-state level of inflation, but again, we face a trade-off here in the estimation. I think this will be like an additional interesting exercise to see. And finally, as a validation exercise, I think it would be nice to compare the implied series of perceived inflation shocks and the inflation target shocks. That's the way I would label the shocks, because in the end, in the imperfect information model, it's like agents start perceiving that the target is changing. In the end, it may be not changing, but the agents may be perceiving that it's changing. How do this shock compares with recent works that are working with these permanent monetary policy shocks, the one of Uribe 2022, and the one there's a paper in the International Economic Review by Mundas and Theodoridis in 2023, where they identify in a VR framework shocks to trend inflation, shocks to inflation target, sorry. So this can be an analogous that he can compare and he can try to validate the shock series that he's getting from the model with this shock series from the VR and try to see if there are some overlap or not. Finally, I found very interesting all the discussion about the disinflation, but I was particularly interested in the last exercise that Peter didn't have time to show, that is the rising inflation target, which I encourage you to check in the paper. So the authors try to use the model to assess which are the effects of rising inflation target, and the particular experiment that he does is that he said, okay, what happens if the Fed decides to increase the inflation target from 2% to 3% in a period of 3 years? So the convergence is like time little by little, like trying to go from 2 to 3. I think it's interesting. It's like there's an announcement today. It would be nice to see like if there's some anticipation effect in this, which is the role, like if today I tell the angels that we are going to converge to 3% in 3 years, probably there will be some adjustment in response to the news. It would be nice to split between an anticipated component and unanticipated component. And it would be also nice to see, like, as an alternative exercise, what would that happen if instead of doing this little by little adjustment, you can just change the inflation target today once and for all. You say, okay, now my inflation target is 3%. How do the results change related to this adjustment that is more gradual? And in the table 5, then he compares, so he just gets the volatility of different statistics in the model, and he compares the sample period before and after. I think it would be nice to show, so in the after period, he's including this convergence period, the 3 years of convergence. I think it would be nice to compare the statistics after the convergence period to try to see if there's some significant change relative to the previous period, because one can imagine that if we change the target, there will be like a change, like a period of adjustment, but after that period of adjustment, do we still see like differences in the statistics? But overall, I think this is a very interesting paper that tackles a crucial question. I think results highlight the importance of a stable perceived inflation target. That is the way I would interpret the shocks in the sense. It would be interesting to consider some extensions to the model, the comparison with the shocks, like this alternative exercise to further validate the results from the model and to reinforce the current results. Thank you.
Thank you, Alejandro. So, Peter, would you like to?
Yes. Thank you, Alessandro, for these very useful comments. So to just briefly respond, so on financial market expectations, so I agree that we go to there especially to look at the post-pandemic dynamics. Of course, kind of like a crucial part of the exercise is to do the estimation in like the 70s and 80s. So we don't have TIPS data going that far back, but you could still, I agree, like look at post-pandemic dynamics. So definitely a good idea. Short-term inflation expectations. So I use those in the estimation of the model. So you could say by construction, it will match it, and particularly it will kind of match the a key feature of the post-pandemic, that you see a huge rise in short-term inflation expectations, and while you see no effect on longer-term expectations at all. So it's going to match that part of the data. But again, as you also talked about, like, I'm just using like the mean forecast, so I'm not like diving into the cross section in this paper at least. But I could perhaps spend more time on it. Steady state inflation rate. So to just sidestep the issue of changes in the functional form of the Phillips curve, I'm just using a near unit root process for the inflation target, because as many of you probably know, Guido Ascari has written a bunch of papers about how ugly the new Keynesian Phillips curve becomes when you have positive trend inflation, and it becomes even more ugly when you have time-varying trend inflation. So I just ignore that. If I just were to like demean the data across the two subsamples, as you point out, the estimate of the volatility of the inflation target would decline. So the reduction would be smaller, but I think at least the qualitative conclusion would still stand. And the path of the inflation target, I briefly mentioned it in the paper, but I should probably maybe show it in a figure and compare it with the paths of inflation targets in other papers. So I can tell you that it's virtually identical to the inflation target in this paper by Cogley and Spadone, which is relatively stable compared to other papers. On the higher inflation target, so essentially people in this exercise, they are actually in a sense anticipating. Obviously they can observe the inflation target, so they don't know the path, but they know that the volatility of the target shock will increase. So in that sense, they will on impact immediately update faster. So in that sense, it is to some extent anticipated. But I think if you really want like a quantitatively accurate answer to like how much would the moments change if you change the inflation target, you would need a slightly more complicated model with time varying volatility and out of steady state Kalman gain, etc. So this was just a small exercise to just show that for like a reasonable calibration, you would see pretty big effects. So I think that would probably hold in a more complicated setting. But thank you very much.
Thank you. So now we open to the floor for questions.
Hi. Yeah, very interesting paper indeed. I had two questions, perhaps one is a long one and a short one. The short one is about the information set of the agents in the model. So you're assuming that they only observe signals about this unobserved component, or they can actually observe the past realizations of the variables? Because since you have persistence in the model, you observe the historical path of the whatever shocks you get, you can actually try to predict this and combine it with the signal to get a better prediction in the Kalman filter. That's one thing. And the other thing is about the comparison that you show us towards the end. So in my view, the initial conditions of inflation is very different between Volcker and post-pandemic, right? So the aggressiveness of the monetary policy to reduce inflation, that is starting at 14% rather than after COVID that you're starting at 7%, must be very different, right? On top of this, the reaction of the fiscal policy actually is also different post-pandemic and in the Volcker situation. I truly believe this anchoring expectations, but I was wondering to which extent this missing this inflation is driven by the anchoring of expectations or the fiscal policy reacting more or less to the increase in the interest rate.
Vitor has a question. Other ones coming.
Nice paper.
Thank you for that comment.
So, so it's a little bit of propaganda. I have a paper with Wagner Gaglianone from the central bank, where we exploit this issue of the bias that Alejandro just mentioned on the consensus. So just using the consensus, it's really biased, but you can extract that and extract from the panel of forecasts, you can extract the conditional expectation if you wish. So there's a way to do that. And it's pretty simple, just using GMM and recovering the biases. So that's one thing to do. And the second is, the second question, you know, every central bank has their own target, but then you have this pi star, if I understood correctly, that's a time-varying target. So my question is, how do you interpret that? And from what I understood, it perhaps plays an important role in the dynamic of expectations. So how do you interpret that?
Okay. Another question over there.
So mine is a bit more of a speculative point. So last week there was this panel at Hoover, I think, and John Steinson was discussing kind of recent experience, etc. And he was discussing the disinflation that we've seen pretty much on these terms, saying, you know, long-term fixed expectations were anchored because the Fed was credible, and hence the sacrifice ratio was quite low. But then he made a point towards the end, which I think we can try to think through your model, which is by not reacting quick enough and by letting the kind of short-term dynamics get a bit out of hand to begin with, they've basically used up credit. And next time around, that used up credit will kind of pay back. So in your model, basically the Fed is benefiting from the fact that you're estimating parameters which are fixed from 99 onwards. So the kind of very good behavior of stuff over the great moderation, I think, plays some part. Question is whether the more recent experience, and for sure doing some time variation in parameters here, it's difficult, but can we try to use them all to think through whether this Steinson point makes sense at all, which is they've used up a bit of this credit, so next time around that kind of persistent shock hits, maybe people are not going to be so sure that they're going to be reactive enough, and hence long-term inflation expectations might de-anchor a bit at the margin.
Okay, thank you. Yes. It's okay.
All right. Thanks a lot for those comments. So first, the thing about improving on the forecast that you talked about, I actually haven't thought about that. I would like to maybe talk about that afterwards. Sounds interesting. So regarding the monetary policy response during Volcker, that would be captured by both. Well, so the response coefficient is assumed constant, but the kind of the preference of the policymaker will then be captured by the time varying inflation target. So the part of the Volcker disinflation is in this model is captured by a reduction in the inflation target, but also some negative temporary monetary policy shocks. But more like the idea of the paper is to show that, you know, you had to reduce the output gap quite substantially, otherwise inflation would never have come down. So that is like I guess like regardless of how aggressively you respond, like the sacrifice ratio would still be large. So how did I interpret the target? So again, the Fed didn't adopt like an explicit inflation target until 2012. So it's an implicit inflation target, obviously it's like a reduced form way of capturing regime changes essentially. So in my mind, it could capture, you know, accommodating supply shocks, for instance, like the 1970s oil shocks. It could also simply capture a preference for a higher average inflation target in the 70s and 80s. But I don't really kind of take a stand on what is driving the implicit inflation target. I just kind of back it out and show that it is pretty volatile in the 70s and 80s, which is a pretty standard result, right? So I think regarding the Steinson point, so as I understand it, he's basically saying that inflation expectations have in fact probably become unanchored because the Fed didn't respond to the increase in inflation initially. Well, first, I think that if you just look at like long-term inflation expectations in the data, I mean, the first 6 months, the first year where the Fed was saying it's just temporary, we're not going to do anything about it, still long-term inflation expectations didn't move an inch. But to give a kind of a proper answer to this, as you also kind of hint at, you probably need a model with some kind of real-time learning mechanism where the gain is time varying, and try to kind of back out how people adjust over time. Because in this model, it's just a steady-state Kalman gain. I'm just looking at large subsamples to get an idea of like what's the average effect. But I mean, just from eyeballing the data, I don't think there was anything kind of suggesting that the initial passiveness of the Fed had much of an effect on the anchoring. In the sense that, so long-term expectations, of course, they increased a bit. So in that sense, they became unanchored, but there was no sign that people were updating faster in light of high inflation. Yeah. I think that's it. Yeah.
Okay, thank you. So we are right on time for the coffee break. Okay, thank you, everybody.